Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing 3M stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or sell. 3M specializes in worker safety, healthcare, and consumer goods. The company produces over 60,000 products under several brand names, including adhesives, abrasives, laminates, fire protection, personal protective equipment, dental and orthodontic products, electronics, insulation, medical products, car products, healthcare, software, and much more. The company is based in St. Paul, Minnesota. Let's get started with the model. This is a large cap company. 96 billion market cap. They're trading at 166 a share, and they have 577 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's dollars. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. The company has positive and growing free cash flow. It goes from 4.9 billion to 6.3 billion. Net income is the profit and loss on the income statement. It's revenue minus expenses. And that's pretty steady, about $4.5 to $5.5 billion a year. Revenue is the sales for the company. That's also pretty steady at around $31-32 billion. And they also have pretty decent margins. Net profit margin is net income divided by revenue. It's how well you convert revenue into profit. And they converted 16% of their revenue into profit, which means 84% went towards expenses. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses that are directly related to generating the revenue. Then the difference between those two numbers is their gross profit. And that's been fairly steady, around $15 or $16 billion a year. Below that is operating expenses. Then the difference between gross profit and operating expenses is their operating income. It peaked in 2017 at $7.2 billion. The company does have a lot of debt, so they had over $400 million of interest payments on their debt. Then there's other income and expenses, which are usually impairments or investments. Then of course taxes. And then the bottom line of the income statement is the net income. And it's pretty steady each year. It was $5 billion in the trailing 12 months. It peaked in 2018 at $5.3 billion. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generated from its operational business. This company did its best in the trailing 12 months. It generated nearly $8 billion of cash flow from its operational business. During a difficult time like COVID, this company is flourishing. Then you have capital expenditures, which are investments in property, plant, and equipment. So if you want to put up another factory to build some products, or if you need to buy some expensive machinery to make some products, that's all part of CapEx. And operating cash flow minus CapEx gives you your free cash flow. And that peaked in the trailing 12 months at $6.3 billion, nearly $1 billion more than 2019. This company does pay a nice dividend, but another way to reward shareholders is to buy back stock. They bought back $2 billion in 2017, $5 billion in 2018, then $1.5 billion in 2019. In 2017, the company issued $2 billion of debt and paid down $1 billion, so they added $1 billion of debt that year. Same thing in 2018, issued $2 billion, paid $1 billion. 2019, they issued $6 billion, paid $3 billion. But in the trailing 12 months, they actually paid down more debt than they issued. Issuing debt is a cheaper way to finance a company. Debt financing is cheaper than equity financing. So debt is just another expense. So as long as the company can pay the interest payments on their debt, it's fine. The problem with debt, if you do not pay your interest payments, you're forced into bankruptcy. But if a company is unable to afford to pay its other expenses, like its electricity bill or one of its suppliers or payroll, they're not forced into bankruptcy. That's the only problem with debt, is that if you can't pay it, you're in default. The most important part of any business is how much money they can generate from their operational business. And this company generates lots of money. and it's improving each year. They go from $6.2 billion of operational cash flow in 2017 up to $8 billion in the trailing 12 months. And the way you calculate operating cash flow, you start with net income, that was $5 billion. Then you have to add or subtract the non-cash items on the income statement. They had $1.9 billion of depreciation. They had positive $242 million of deferred taxes. So we have to subtract that out on the CFO section. Then there's $264 million of stock-based compensation. They had a positive $1 billion of cash inflow from changes in working capital. So if a company uses accounts payable, that's a cash inflow because they're receiving a product or service but not paying for it. They're going to pay for it in the future. Or when a company sells inventory from its balance sheet onto its income statement, that's another cash inflow. Or when a company receives payment for a product or service it's sold on credit in the past, that's another cash inflow. And you may be wondering, how could their net income, their profit, be $5 billion, but they had $8 billion of cash flow? A lot of people think of net income as how much money the company made, but it's just accounting profit and loss. The actual cash they generated is on a cash flow from operations section. I can create a company that has billions of dollars of accounting profit, but is losing tons of money. I could also create a company that has negative billions of dollars in profit, but is generating billions of dollars of cash flow. So you have to look at both statements, the income statement and the statement of cash flows, to get the whole story for a business. I know it's a little difficult at times, but the more you do it, the better you get. Let's look at a capital structure. $10 billion of equity, $21 billion of debt. They're 32% equity, 68% debt. So they're a bit leveraged. They have a lot of debt. And their WACC is 8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $139 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $126 billion. We divide that by 577 million shares. And we get a calculated stock price of $219. They're trading at $166, so they're trading at a 24% discount. It's a buy according to the model. Simply Wall Street values the company at $209, so they're also saying the stock is undervalued. It looks like the stock peaked about $230 a few years back, but it's come down little by little ever since. It seems like it's trading at a really good value. The company raises its dividend each year, and they pay a 3.53% dividend yield. That's annual dividend payment over market cap. Or you could sum the last 4 dividend payments and then divide that by the stock price. They pay out 68% of their net income and 54% of their free cash flow. The company has a pretty low beta, 0.92, so the stock moves a little less than the market. The stock has gone down 8% in the past 52 weeks, much worse than the S&P 500, which went up 15%. The low was 114, the high was 182. The stock is trading slightly above its 200-day moving average, but well below its 50-day moving average. And about 2.5 to 3.5 million shares are traded each day for this stock. And almost all the shares outstanding are on float. And about 2/3 of the shares are held by institutions. Only 1.3% of the shares on float or shorted. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $25,000 today. If you did not reinvest the dividends, you'd have $23,500 today. So if you invested $10,000 into this company in January 2011, you would have been up a little off the bat. Then you would have been down to about $9,000, and you might have sold because you got upset. But if you would have held out a little longer, you could have sold for over $30,000. But if you're still holding, you're at $25,000. That's a pretty good return on investment. Vanguard is the biggest shareholder at 7.8%, then BlackRock at 6.7%. Then State Street, Newport, and State Farm. Let's look at their financial ratios. The average PE in the market is 11.7, the median is 14.8. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 19.3, a little worse than the median and average. 19.3 means investors are paying $19.30 for $1 of earnings. Price to sales is stock price over sales per share. They're at 3.0, between the median and average. Price to book is stock price over book value per share. They're at 9.5. And the way you calculate book value per share, that's equity over shares outstanding. Equity is assets minus liabilities in the balance sheet. And they have $10 billion of equity, but negative $10 billion of tangible equity because they have almost $20 billion of intangible assets on their balance sheet. Interest coverage ratios, EBIT over interest expense, they're at 12.2, so they can easily cover their interest payments. ROE is net income over equity. They have a great ROE at 49%. Current ratio is current assets over current liabilities. They have a great current ratio at 1.4. And their current assets are $2.5 billion of cash, $5 billion of receivables, and $4 billion of inventory. So the company does seem to be well capitalized because they have $6.3 billion of free cash flow, $3.7 billion of working capital, and they also have a $3.4 billion dividend payment. The best way to look at ratios to compare them to similar companies, I've done videos on Ultra, General Electric, Graco, Honeywell, and Savaria, all in the same industry as 3M. And if 3M has a number in green, they're better than the average. If they have a number in red, they're worse than the average. So they're better in PE because a lot of these companies are negative because they have negative earnings. They're also a little better in price to sales. They're much worse in price to book than the average. They're worse than average in current ratio, but 1.4 is fine. They have a great ROE, the best of any company. They do have a lot of debt, a lot higher than average. And they're a big company, almost 100 billion market cap. And they pay a great dividend, more than any company in this industry. So to summarize, I have them trading at a 24% discount. They have lots of free cash flow, and it's growing even more during coronavirus. They sell so many important brands, and this company is very well known, not just in the United States, but all over the world. Definitely a good long-term investment, one you could just sit on and not worry about. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.